Welcome back to the channel. I'm Algabot, and in this video we're going to take a careful, educational look at an expert advisor for MetaTrader 5 called Prior Day Fakeout Reversal. This is a pure price action strategy, with no indicators at all. Instead, it watches the previous day's high and low, and it looks for moments where price briefly pushes past one of those levels and then snaps back inside. By the end of this video, you'll understand exactly how the strategy reads the chart, how it manages its stop loss and take profit, and how it sees the market candle by candle. Let's get into it. So what exactly is Prior Day Fakeout Reversal? At its core, this is a pure price action reversal strategy. It carries no moving averages, no oscillators, and no indicators of any kind. The only things it cares about are two levels, the high and the low of the previous calendar day. Those two prices are some of the most widely watched reference points in intraday trading, which is precisely why the strategy pays attention to them. The idea is built on two simple price action concepts. The first is support and resistance. The prior day high and prior day low are levels that a large number of traders are watching, so resting orders tend to cluster just beyond them. The second concept is the failed breakout or fakeout. When price briefly pushes past one of those levels and then closes back inside the range, the traders who chase that break are left offside. This strategy is designed to fade that move, taking the opposite side once the break has clearly failed. In terms of markets, the strategy is symbol and time frame agnostic by design, because every threshold is written as a fraction of the prior day range rather than a fixed number of pips. That said, it's best suited to intraday foreign exchange, pairs like euro to US dollar on something like the 15-minute up to the 1-hour time frame, where the day's range and the levels around it carry the most meaning. Who is this approach for? It's really aimed at traders who are curious about mean reversion and price action logic, and who want to study how a rules-based system defines a setup, places a stop, and sets a target without relying on any indicator. As always, everything here is for educational purposes only. It is not financial advice, and trading carries real risk, including the risk of loss. Let's break down the mechanics step by step. The strategy works on a single principle: failed breakouts of the previous day's range. Before anything else, the EA acts only once per newly closed bar. It waits for a candle to fully close before making any decision, so it's reacting to confirmed price action rather than to a flickering, unfinished candle. The first thing it does each new bar is build the previous calendar day's high and low. It scans back through the bars, skips everything that belongs to the current day, and then measures the full high and low of the day before. Those two values, the prior day high and prior day low, become the reference levels for everything that follows. The distance between them is the prior day range, and almost every threshold in the strategy is expressed as a fraction of that range, which is what lets it adapt to different symbols and time frames. Next, it examines the bar that just closed, the candidate fakeout candle. For a short setup, the EA checks whether that candle's high pushed above the prior day high. The penetration has to be at least the minimum poke fraction of the range, so a tiny touch doesn't count, and no more than the maximum poke fraction, because beyond that it's a genuine breakout to skip. On top of that, the candle has to close back below the prior day high, and it has to have a bearish body, meaning it closed lower than it opened. When all of those line up, the strategy reads it as a trapped breakout above the high and signals a short. The long setup is the exact mirror. The candle's low has to poke below the prior day low by an amount inside the same minimum and maximum bounds. It has to close back above the prior day low, and it has to have a bullish body. That's read as a failed break below the low, and the strategy signals along. Now the exits. For a short, the stop loss is placed just above the swept high, with a buffer equal to the StopBufferFraction of the range. The risk is the distance from entry to that stop, and the take profit is set at the reward to risk multiple times that risk, which is 2 times by default. For a long, it's flipped. The stop sits just below the swept low, and the target is the same multiple of risk above the entry. Once a position is open, the EA holds just one trade at a time and lets the stop and the target manage the exit. Let's look at the actual MQL5 code that runs inside MetaTrader 5. At the top, you can see the input parameters. These are the settings you'd adjust in the EA's properties. MinPokeFraction and MaxPokeFraction define how far price has to push beyond the level for it to count as a fakeout rather than a touch or a real breakout. StopBufferFraction controls how far past the swept extreme the stop sits. TpRewardRisk is the reward-to-risk multiple, set to 2.0 by default. Lots is the order volume, and magic is the identifier the EA uses to track its own trades. Below the inputs are the two signal blocks. The short block first measures poke up, how far the signal candle's high reached above the prior day high. The short setup condition is true when that poke is at least the minimum, no more than the maximum. The candle closed back below the prior day high, and its close is below its open, meaning a bearish body. When all of that holds, the code reads the entry from the bid, places the stop just above the signal high plus the buffer, sets the take profit at the reward-to-risk multiple of the risk, and calls trade.sell. The long block is the mirror. It measures poke down below the prior day low, checks the same minimum and maximum bounds, confirms the close came back above the prior day low, and requires a bullish body where the close is above the open. Then it reads the entry from the ask, sets the stop just below the signal low, sets the take profit above the entry, and calls trade.buy. Two clean, symmetrical blocks, one to fade a failed break of the high, one to fade a failed break of the low. Let's bring this to life on a chart. What you're looking at is an illustrative example on a Euro to US dollar style chart. The two dashed horizontal lines are the heart of the whole strategy. The upper line is the prior day high, sitting at 1.0900. The lower line is the prior day low, at 1.0840. Everything the strategy does revolves around these two levels, because they're the boundaries of yesterday's range and the prices that the most traders are watching. We'll start with the long trade. On the left, you can see price drifting lower, candle after candle, sliding down toward the prior day low. As it reaches that lower line, watch closely. The next candle dips below the prior day low. Its wick pushes clean through the level, dropping into a fresh low beneath the line. For a moment, it looks like a downside break. But by the time that candle closes, price has been pushed all the way back up, finishing above the prior day low with a bullish body. That is the fake out. The break failed, and the sellers who chased it lower are now offside. There's an important nuance to that dip below the line. The strategy doesn't accept just any move beyond the level. The penetration has to be meaningful, at least a small fraction of yesterday's range, so a candle that barely grazes the line is ignored. But it also can't be too deep. If price drives far below the level, the strategy treats that as a genuine breakout rather than a fake out, and it stands aside. So the poke has to land in that middle zone, far enough to sweep the resting orders beyond the level, but not so far that the market has truly broken out. This is exactly the condition the strategy is waiting for. On the following candle, the buy entry marker appears, just above the prior day low. Notice where the stop loss sits, just below the swept low, beneath the deepest point of that fake out wick, with a small buffer. The risk is the distance from the entry down to that stop. The take profit is then set at twice that distance, because the reward-to-risk multiple here is 2.0. Now follow the move. The candles after entry turn higher, one after another, climbing back up through the middle of yesterday's range. Price works its way up until it reaches the take profit target near the top of the range, and the long trade closes for a gain in this illustration. The idea is simple. When a break of the low fails, price often rotates back toward the other side of the range. Now let's look at the short trade, which is the mirror image. After that rally, price is now trading up near the prior day high. Watch the candle that tags the upper line. Its wick pushes above the prior day high, printing above the level, and again it looks like a breakout, this time to the upside. But the candle closes back below the prior day high, finishing with a bearish body. Another failed break. The buyers who chased the move above the high are now trapped. That's the short condition confirmed. On the next candle, the sell entry marker appears, just below the prior day high. The stop loss sits just above the swept high, above the tip of that upper wick, with the same small buffer. Once more, the risk is the distance from entry up to the stop, and the take profit is placed at twice that distance below the entry. From there, price rolls over. Candle by candle, it works lower, back down through the range, until it reaches the take profit target near the lower half of the range, and the short trade closes in this example. So in both cases, the logic is identical, just flipped. A poke beyond yesterday's level, a close back inside, and a rejection body in the opposite direction. The stop goes just past the extreme that was swept, and the target is a fixed multiple of the risk. Notice the strategy never needs an indicator to do any of this. It reads structure and the behavior of the candles alone. And that brings us to the end of our walkthrough of the Prior Day Fakeout Reversal Expert Advisor. We covered the core idea of fading failed breakouts of the previous day's range, the exact conditions the strategy uses to signal a long or a short, how it builds the prior day high and low, and how it places its stop loss and take profit around each setup. We also watched both a long and a short play out on the chart, candle by candle. Remember, everything in this video is educational information only. It is not financial advice, not a recommendation, and not a solicitation to trade. If you found this breakdown helpful, please like the video, leave a comment, and subscribe for more MetaTrader 5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.